Welcome to the first ever episode of The Home Show with Rich Price and Adam Black. My name is Rich Price. This is my co-host, Adam Black. I am a realtor with Keller Williams here in the Jackson, Mississippi metro area. And Adam is a mortgage broker here in the area with First Commercial Bank. And we're excited to have you with us today. For our very first topic today, we are going to be looking at how much money do you need to have to buy a house. But before we get into that, Adam's going to give us a brief update on what's going on with interest rates, because for the first time in a really long time, it's some positive news. All right, Adam, what do we got?
Hey, Rich, thanks for having me, man. And yeah, you're right. I'm glad this is the first one we're doing, because there's been several months where I wouldn't wanted to be on here. But yeah, man, November has brought an early Christmas for us. A lot of things are happening in our business right now. Pull up a couple of notes here for myself, just so I can stay on track. So Powell spoke last Friday, alluded to the Fed's reluctance to raise the Fed rate any further based on inflation numbers and all the supporting reports that are coming out. They're all showing evidence of the economy slowing, which is a bad thing for the general public, but that is what has to happen for inflation to go back down. Rumor has it, also released this week, is that the Fed will not only pause raising rates, but they will put two lower rate cuts in 2024. Now, when that'll be, who knows? Probably after Q2, I would think.
Yeah.
All these things have brought some fresh money back into the mortgage-backed securities bond market and helped mortgage-backed securities. Of course, when mortgage-backed securities get better, rates get better. Mortgage applications nationwide up for the last 5 weeks, signifying consumer confidence in the market. And rates have improved on average about 1% since mid-October. So that has been huge news for us. So I wanted you to bring up a slide of the mortgage-backed securities over the past 30 days or so. So what you see here, and this is without getting too technical, days in green means rates are getting better. So for once, we've had a 30-day period where we've got more green days than red days. And as you see that general incline going up, that is mortgage-backed securities getting more appealing to investors, if you will. And therefore, they're buying more. What does that do? That lowers rates to the consumers. So this is what we wanted to see. It is just, for the first time in, 16 or 18 months, we've really got a lot of momentum right now. And we are seeing the signs we need to see to tell us that, hey, this thing's getting better. So here's a kicker to that is more lower rates mean more people coming back into the market. So I feel like you're going to say, what's that going to do? And you're going to tell me that that's probably going to spur some activity, and we're already in a low inventory market. So am I correct?
Yes, that's correct. So just for historical reference point, October and November nationally, it's the lowest home sales in those months since 2001. So we didn't even see home sales nationally this bad post the 2008 market crash. So buyer activity has slowed down tremendously October and November because, as much as we'd love people to just keep buying houses every day, most people don't want to buy a house with an 8% rate. But things are moving in the right direction. And all of a sudden, like, December has gotten incredibly busy for me. I've got people coming out of the woodworks who are wanting to get re-engaged with their home search. They decided to put off for a while. And I think that's only indicative of more things to come. I think January is going to be an unusually busy January. January is typically when we're like, okay, let's just get to February, and February is more like, let's just get to March. But I think January is going to be potentially a pretty busy season for us in the industry. And because so many buyers have backed out of the market over this past year, it's obviously affected people in the real estate industry. Not as many people are getting as much business. And so I think we're going to see a little bit of attrition here in our local and national realtor professional pool. So as that happens, I think more and more realtors who are engaged in the business are going to stay busy. And I think it is a prime opportunity for buyers in January, and even in December, but especially January. January is always, on average, the lowest median sale price per year. It dips down every January because it's post holidays, just not as much activity. So you've got the general momentum of interest rates moving in the right direction that have a rate that you can feel good about getting locked in at. And secondly, on average, your median purchase price is going to be the lowest it'll be at any other time during the year. So buyers who are on the fence right now, now's the time to get engaged. March, April, May, when things are really heating up, it's going to be competitive again. It's not going to be as competitive as it was a couple of years ago when it was like a bloodbath, but I think it's going to be busy. So, as we're talking about what does it look like for a buyer to get re-engaged in the market, to think about making a move, the big question, and it's our big topic for today, is how much money do you need to purchase a house? And you and I have talked about this a lot. There are a lot of different factors that go into this. And unfortunately, there's not a clear-cut answer for what you need to have if you want to purchase a house. And so we're going to look at a few different factors, like how much money do you need for a down payment? We're going to look at closing costs, earnest money, some miscellaneous expenses, your inspections, and things like that, to at least get you a rough sketch of what you need to have set aside if you are planning to be a buyer of a home in 2024. So, Adam, let's start with our different loan programs, because each loan program has a different down payment amount. And that's the big one everybody's worried about, is how much do I need for a down payment? So you put together a really nice slide that kind of compares what you need for these loan programs. You want to talk us through kind of what some of these are and what people need to expect?
Yeah, absolutely. And this is what I call the big four. There are a number of loan programs out there. Gosh, it's infinite, because every bank's got their own in-bank products and things like that. But the big four, what we consider conventional, FHA, USDA, and VA, with probably conventional and FHA being the two most used out of that.
Mm-hmm.
Down payment wise, you're looking at, on a conventional first time home buyer, 3% down, subsequent home buyers 5% down. Now that's a big rumor, right? Well, I don't know how to say it. Wives' tale that everybody thinks you have to have 20% down. That is absolutely
general misconception.
General misconception. Thank you. Yes, that is absolutely not true. 3% first time home buyer, 5% subsequent home buyers. FHA is actually 3.5%, and I noticed this is wrong. It's got 3%, but it's 3.5%. USDA requires no down payment for qualified borrowers, and VA is the same way. Minimum credit score wise, lowest you're going to be able to go with any of those programs is 580, with conventional being 620. Other than VA doesn't call out a minimum credit score. It's all about what the system will approve. I've seen it approve 580s. I've seen it not approve 680s. So it just depends on what it approves. Seller concessions. This is the big one right now, because seasonality has set in and things have slowed down a little bit. So sellers are more apt to give up some concessions in the sale. And conventional is broke down into tiers based on your down payment, 3%, 6%, or 9%. And that is of the sales price, so keep that in mind. Mm-hmm. FHA is just a flat 6%. So 6% of the sales price. $200,000 home, seller can contribute up to $12,000. USDA is 6%, and VA is 4%, but there's a caveat there, and I'm not going to get into the weeds on that. VA actually calls out some different things on closing cost. You're allowed to pay 4% of the closing cost. Those are closing costs contributed to it, but then the seller can also pay other things, even collections, to help a buyer qualify. So I'm not going to get into that today. That's way too much in the weeds. Mortgage insurance. This is a big one. People don't really understand mortgage insurance. And real briefly, all mortgage insurance is this protection for the lender. They're making you pay a policy because you're not putting 20% down, so that, God forbid, if the house gets foreclosed on, they can come in, sell the house. Any losses they incur can be taken out on this mortgage insurance premium. So, and guess what? You're required to pay that for them.
Yeah.
Yeah, it varies on conventional.
Yeah, just to clarify on that PMI. So if you have any loan that you do not have 20% down on, you're going to be paying PMI, correct?
Yes.
Yes.
Yes. Except for VA.
Okay.
And I'm going to correct that too. I'm sorry about that. Yes, VA has nothing, has no monthly mortgage insurance. It has an upfront funding fee, but no monthly mortgage insurance. Conventional, it is less than 20%, yes, and it varies. And caveat to that, MI mortgage insurance has gotten really, really affordable the last few years. Big misconception. I was talking to someone the other day and they thought, well, my MI is going to be like $200. It was 40.
Yeah.
So a lot of times people are really stretching themselves trying to put that 20% down, and they don't have to because there's not a big difference in the payment. FHA does require it. It's 0.55%, and USDA, I believe, is 0.5%. So those are set regardless of how much you put down.
Yeah.
Total DTI, debt to income ratios. Your debt to income ratios is the amount of debt you have on a monthly basis divided by your gross monthly income. Okay, that's something a lot of people don't understand. We qualify everybody off of gross monthly income.
Yeah. So before taxes, for those of you who
That's right, before taxes. I'm sorry.
between gross and net. Yeah.
Yes, right. And thanks for bringing me back in on that. I get so used to saying it that a lot of times I just don't think about everybody doesn't understand that, Rich. Appreciate that. On conventional, it calls out 45% in the guidelines, but you will see the system sometimes approve up to around 48, 49%. FHA, again, calls out 55%, but I've seen it approve as high as 59%, which is really getting high. That's one of those deals where,
Yeah.
I'd really caution someone in that position unless you've got more income that is going to come in soon, or maybe some debt that's going to be relieved soon. That's just really stretching someone.
Yeah.
USDA is pretty hard and fast, 41%. It's rare that it will approve it above that. And it's going to consider the housing debt to income ratios and the total debt to income ratios when it's giving you anything over 41. VA, again, calls out 50. I've seen it approve up to 59%, believe it or not. So it's VA is probably your most liberal underwriting program, but of course it's only for veterans, surviving spouses, a couple other little caveats there who would qualify for it.
Yeah.
Pros and cons. Again, I don't want to make this too long, but conventional is low down payment, 3% first time home buyers, 5% subsequent, no upfront fees, and the loan limits are higher. FHA, low down payment, 3.5%, usually has a lower interest rate than conventional, actually. Easier credit qualifying. They're a lot more looser with their what they will approve in underwriting. USDA, no down payment at all, lower interest rate, and lower mortgage insurance. And then, of course, VA is, again, no down payment, lower rate, and no MI. Their rates are really good right now. Cons of these, and I know I'm speeding through this, but we're going to put a link to this in the comments below if anybody wants this. The cons to it requires better credit on conventional. So even though it says it'll go down to 620, it's rare that we'll approve a deal under 700. Lower DTI ratios, they're pretty strict on those, and stricter underwriting overall. FHA has an upfront funding fee. A lot of people don't know this. Even though you're only required to put 3.5% down, you pay an FHA funding fee of 1.75% that goes back on your loan amount. So you're negating about half of your down payment there. I always compare FHA and conventional together to look at the lowest overall cost of a mortgage when I'm working with someone. And FHA does a little bit stricter on appraisals. There's minimum property standards is what they call those, chipping paint, rotten wood, things like that that would normally be okay on a conventional deal won't work on an FHA. Same on USDA. It has an upfront funding fee, 1% of the loan amount. Does require mortgage insurance, and it must be in a USDA area. Now, that's one unique thing about USDA is it has to be geographically in a USDA approved area. A lot of people are surprised because that's a USDA rural development loan. A lot of people think that means out in the country, but like right here in our area, that we've got, out toward Flowood, a lot of that qualifies in some of those nicer neighborhoods. So it
Yep.
does have to be in a USDA area, but you're usually surprised at where those are.
Yeah, absolutely. And I mean, the big takeaway with these different loan types, because I mean, one, like you said, anyone who wants this, they can download it. You be able to, kind of have this as a little cheat sheet. But the biggest deal is talking with a great lender like yourself, who's going to be able to help people navigate what is the right kind of loan for their situation. I've never talked to any lender who has said, I'm going to try and put my client in the most expensive loan. I'm going to juice them for every penny. Yeah, because if anybody did that, you guys would be out of business in a hurry because no one would want to work with you. And
That's
so,
right.
Every lender wants to get a potential buyer set up in the best loan program for them. And so, the biggest step for you as a buyer, if you're thinking about buying in the future, to take is to, hey, let's get set up an appointment with Adam, or if you already know a lender who's going to be second, third, or fourth best in the business, you can, go meet with them and then come meet with Adam.
Right.
But, the short of it is meet with a good lender who's going to be able to help you get into the right loan program for your particular situation, because loans are not one size fits all. Everyone's circumstances are different. Everyone's financial landscape looks a little different. And so there are things that are right for you. So that's everyone's big question, is how much do I need to have for a down payment? And so, as you can see by the info we just went through, it really varies, and there's a lot that goes into it. There are a lot of factors to consider. So
that's right.
Yeah. So some of the other things that you're going to need to be prepared for. This is a concept that a lot of people are unfamiliar with. And when I bought my first house, I wasn't familiar with it either. It's called earnest money. So earnest money is money that you as a buyer put along with your offer to purchase a property, that is your way of saying, hey, I'm really serious about buying this property. And if for some reason I back out of this contract for a reason that isn't allowed in the contract, like if the inspection goes great, but you just get cold feet, then the seller gets to keep that earnest money in a way of paying for any damages for them. If they had to move their move date back now because they're out of contract, they got to go back on the market, etc. It's a way to compensate them for their time lost on the market. So generally, my recommendation to clients when I'm working with a buyer is that we put forward 1% of the purchase price. So if it's a $300,000 home, that's a $3,000 earnest money check. It's generally accepted that people do, and I advise my clients a minimum of $1,000, but but recommended 1% of the purchase price. And the reason we do that is twofold. One, if we're in a competitive situation where a seller is looking at one contract versus the other, and they're basically apples and apples, and they see that this person has put $3,000 worth of earnest money down and this person has put $1,000, they're going to feel like this contract has a little bit more seriousness associated with it, and they'll take you more seriously as a buyer. The second thing is the money that you use for your earnest money is going to go into your down payment or purchase price, whatever. It's going to take money off of the top of your contract. And so it's not like magic money that just disappears out into, the financial ether. It's money that goes toward the purchase price of your home. So you're not losing out on anything. And so it's going to be a wash either way. So if you have the cash up front to do a more significant earnest money payment, that's my recommendation. Adam, any thoughts on earnest money, what you've seen?
Yeah, man, same thing. Years of doing this. The deals that I see when we're in a multiple offer situation, that is one of the compensating factors is how much are they putting down? I mean, that money is good faith. That is saying, hey, I am serious about buying your home. I don't want to tie it up for 30 days. And to show you that, I'm going to come out of my pocket with this amount. It's funny that you say that about it going toward closing costs and cash to close, because when we send people their initial docs, if we don't list that earnest money, that's the first call we get. So yeah, I get it. They want to make sure that money's being, being taken care of. So yeah, I get that. But it's kind of, in my opinion, it's kind of an overlooked thing as far as strength of offer. I really believe that. I'm like you. I've seen some deals before where somebody's offering, $250 or $500 in earnest money, and sometimes that's all you got. I get it. Yeah. But man, it does weaken the offer. I believe that.
It does. And honestly, if that's all the cash you have, probably it might be time to reconsider, hey, can I actually afford to buy a house right now? You want to come into this in as good of a financial position as you can. And part of that package is your earnest money. So something to consider. So
absolutely.
So the next big thing that is also really confusing for a lot of people is money for closing costs. Closing costs, it's like a big umbrella term that goes into basically two big buckets. So you've got closing costs that are associated with your lender. You have closing costs that are associated with the title company or closing attorney who's going to be helping you get to the finish line from a legal paperwork standpoint. So Adam, can you talk a little bit about what closing costs are? And just to give you guys, before we jump into that, a general window, like closing costs, they kind of vary, but on average, probably looking at about $6,000 on average for a normal file. And that's going to include both seller and buyer closing costs, both for the lender and for the closing attorney. So it's kind of all in one big bucket. But what do the lender fees look like?
Yeah, so you're right. That's about the average in our area. And one misconception with a lot of people is that all closing costs belong to the buyer. Legally speaking, from my perspective,
yes,
everything belongs to the buyer. Then seller concessions are applied to that. Now, one thing that a lot of people don't understand is that you actually have two sets of costs from a mortgage perspective. You have closing costs and you have prepaids. The prepaids are your first year's insurance and your escrow setup. And we'll get into that in another segment of this. But a lot of people drop prepaids under that umbrella of closing costs. So when we say $6,000 or $6,500, that is all the closing costs. That's the lender fees, the appraisal fees, the attorney fees, all the vendors and third parties that are doing something related to that transaction. All of those go toward the buyer side, and then the concession is applied. And then on top of that is your prepaids are added to that as well. So it's two sets of costs brought into one, and then a concession applied to that from the seller.
Yeah. So generally, the way I like to advise the people I'm working with is that let's assume that a seller is not willing to give any concessions. So as we're putting our offers together, and as you're putting your financial package together, getting ready to buy, let's just assume that you need $6,000-ish to go along with whatever other expenses you have. That's going to put you in the strongest position as a buyer to make sure that you're not getting out over your skis financially. And if you fall in love with a house, but you don't have the money to get to the closing table because of closing costs, and you have to rely on seller paid concessions on closing costs, this is really not the ideal way to approach a situation. So if you can set aside money to cover those closing costs, that's all of them, on average, I think that's probably our best foot forward as a buyer.
Yeah. Totally agree with that.
All right. So one other kind of big expense that's typically associated that people need cash in hand to do along the way are inspections. When you buy a house, 99.99% of the time, you're going to do a general home inspection, which on average are going to be $400-ish. It can be as low as like $300. It can go up, significantly more than that, depending on the size of a house. If there are other extenuating circumstances, like if there's mold that needs to be inspected or tested. What's that?
Swimming pool.
Yeah, swimming pools.
Pool inspection. Yeah.
Yeah. So those costs can go up, but on average, if you're looking at, kind of a normal house, probably plan on $400-ish. And if you need to have additional inspections, very common in our area is to get a structural engineer or foundation company to come do an inspection. If you get a structural engineer, it's going to be, $200 or $300 to get them to come out. But honestly, it's money better spent ahead of time, so you have peace of mind if you have any concerns about the foundation. So just set aside, several $100s for inspections, and kind of the last big bucket of the money that you need to have saved up and set aside to purchase a house kind of fall in this miscellaneous expenses bucket. There's a million things along the way when you're buying a home that are going to show up that you're going to need to pay for. It's going to be things like your utility deposits. You might need to buy boxes of packing tape if you're going to pay a moving company, or you need to rent a U-Haul truck, or if you need to buy pizza for the friends you suckered into moving all your crap.
It's always your first house. That's only on your first house.
Yeah. Every friend that I've ever had, by like the time they hit 30 years old, they're like, I'm never helping you move again. It's like, okay, yeah, I see yeah. So if you're 29 or below, you're probably still in the go zone, but if you're above 30, just plan on hiring a mover. So, but yeah, there's a lot of little miscellaneous expenses that can come up. So I generally recommend people have, maybe $1,000 set aside, because when you get into your new house, you're going to need shower curtains. You're going to need, organizers for your drawers, cleaning supplies. There's a million things you're going to need. Dryer vent hose. Yeah. What'd you just say?
Blinds is a big thing that people don't think about. My gosh.
Yeah.
They can get expensive. Yeah.
They can get really expensive. I mean, it's going to be $50 a pop at Lowe's, or if you're going to do custom blinds, thousands of dollars you could be spending. So, you don't want to be stuck in a house where you can't walk in front of a window, in the comfort of your brand new home. So
when I was young, I may or may not have had one of those Navajo blankets hung over the window, when I was 19, rocking the rental, but you can't get away with that anymore.
That's right. So, like we talked about at the beginning, interest rates are heading in the right direction, which is really good. They're still, it's not like they're super low at this point. And so one of the things that we'll have for you to download, there'll be a link to it in the comments. I wrote a short ebook that's got 4 ways that you can beat higher interest rates. So you'll be able to download that. And we thank you guys so much for tuning in. Adam, you got any parting shots for us before we head out today?
Hey, man, let's just keep moving forward. Let's keep watching inflation. That's going to tell you what rates are doing. And hope this ship's about to turn around.
Yeah, I hope so too. Thank you guys for joining us for the first episode of The Home Show. And we're going to try and do this every month. Thank you guys for tuning in and making it this far with us. And we'll catch you next time.
Thanks, buddy.
Thanks.